Hello everyone. So right now we are kind of presenting our key ratio analysis for Padini and as well as why we should choose Padini over Bonia when we compare the 5 years trend. So let's begin with our team introduction. Our team consists of Ren Xinyan, which will be responsible for introduction and also conclusion part. And then Lucy Tia and me will be myself, Stephen Chil Samirin, will be responsible for the 5 year trends analysis compared to Bonia. And as well, Yanting and Pei Ling will be responsible for the Pardini key ratio analysis. So without further ado, I pass on to Xinyan. Thank you.
I will begin with the introduction. Houdini switched from a department store to fashion in 1975. Today, it runs 9 sub-brands and operated 153 self-managed stores across Malaysia plus Cambodia, Bahrain, and Brunei, and sells online through its own e-commerce site. Bonia, by contrast, focus on premium leather goods. It recently partnered with Maxi to enter Shopify Plus and open flagship stores around ASEAN. Its 5-year quick ratio stays around 2 times, reflecting lean but tighter liquidity. So why we choose Bonia? The reason that we compare these two companies because they both are Malaysian fashion retailers of similar size, yet they serve different markets. Pardini targets the general consumers, while Bonia focuses on premium customers, which offers a clean and meaningful contrast. So we use 5-year data from TradingView to mirror performance with 5K ratios highlighted in the paper. Net profit margin, quick ratio, inventory turnover, leverage, and earnings per share to better understanding each company's strengths and weakness. And the next part is Xiaoyan. Fast forward to the recovery in 2021 and 2022, Patin's margin inched back up, hitting around 12% in 2023, while Bonia briefly jumped ahead in 2022, but only because it had one-off sales boom and inventory write-backs. Patin's growth was steadier, followed by smart warehouse automation and lean operation partnership. In 2024, both companies felt the pinch from high cotton, energy, and shipping costs, and Patini's margin settled around 7.6%, whereas Bonia's 8.2%. Again, Patini inflected less. Let's look at the liquidity. Patini's quick ratio, basically its ability to cover short-term bills, jumped from about 2.6 to nearly 4 during the worst of the pandemic. Then moderate back around 3. That tells you Padini holds enough working capital to seize opportunities and wide downturns. Bonia, on the other hand, hover around 2. Sure, that's help boost returns when sales are hot, but it also means Bonia is more valuable if credit tightens or expansion comes back. So here's the bottom line. Bonia can outperform in buoyance, but Patini delivers steady margin and stronger liquidity year in year out.
If you are building a portfolio that balances growth with risk management, Python is the right backbone you need. Thank you very much. And next, let's hand it over to Steven.
Alright, thank you. So moving on to the next reason is from the inventory turnover ratio analysis. So as we can see in the graph here, post-COVID during 2019 to 2021, both companies experienced a downtrend. This is because of during the COVID era, there are MCO imposed as well as all other restrictions, which leading to the closure of the stores as well as disposable income for people is decreasing as well. So that's why the buying power also decreasing, leading to the lower inventory turnover ratio. Means that for one cycle, it takes longer time for an inventory to be replaced. And then after the MCO are gradually lifted, we can see from the 2021 here to the 2022, both company inventory turnover ratio is actually spiking, but Padini comes up as a winner. Actually, Padini inventory turnover ratio is always higher than Bonia. It's because of we are trying to do some research. We managed to identify that Bonia is more focused towards the luxurious and high price fashion. That's why Bonia cycle is longer than Padini. While Padini is focused more on faster fashion cycles. That's why Padini inventory turnover ratio is higher because they can replace the inventory faster than Bonia. So actually we recommend Padini as well in this ratio. Moving on to the next ratio, thank you.
You can see from this graph, Padini's leverage ratio is more outstanding than Bonia's, based on its financially resilient and strategically disciplined choice in performance. Padini's leverage ratio rose temporarily from 0.03 in 2019 to 0.37 in 2020, largely due to pandemic issues, which driven use of overdraft and lease liability recognition under IFRS 16. However, what followed demonstrates strong stewardship as well. From 2021 to 2023, Padini generated nearly 1 billion in free cash flow, allowing it to reduce its leverage ratio steadily to 0.31, 0.26, and 0.28. In 2024, it maintained a healthy leverage ratio which is 0.3, firmly with the low debt net cash position. This is not only supports a dividend payout of over 40%, but also ensures ample refinancing capacity and operational stability. In contrast, Bonia's leverage was lower on the surface, rising from 0.11 to 0.23 in 2019 to 2021 due to brand repositioning and store upgrades, while it aims to control leverage through asset sales and share buybacks. The consistent shrinkage in equity due to buybacks and dividend has narrowed its financial buffer. Combined with volatile cash flows, this raises concerns about Bonia's long-term debt repayment ability, especially in weaker market conditions. The reason we should choose Padini is about it has proven ability leverage in quickly post-crisis, a stronger operating cash flow to support dividends and debt reduction, a stable capital structure with less reliance on asset sales, and also more resilient in downturns, which thanks to a wider equity base and consistent performance. Padini's approach reflects a prudent survival first, recovery later strategy, whereas Bonia's flexibility comes with a greater financial fragility. For long-term investors seeking reliability and consistent returns, Padini offers a more solid and sustainable investment profile. Now I will pass to Yan-Ding.
I will explain from the perspective of earnings per share that Padini is a more worthy choice for long-term attention. Let's first look at the EPS performance, which is a key indicator for measuring a company's profitability. In 2020, due to the impact of the pandemic, Panini's EPS dropped from 0.08 to 0.0, while Bonia was close to breaking even with only about 0.01 million. In 2022, with the economic restart, Panini rebounded to 0.16 through the membership day activities, and Bonia recovered to 0.2 by relying on the new high-end headline. In 2023, it raised its peak with Panini earning 0.27 from the combination of tourism and its overall, and Bonia earning 0.27, but it relied on a one-time asset sale and had poor sustainability. In 2024, under the cost portion, Panini remained at 0.15, while Bonia dropped to 0.173 due to the decline in arbitration income. Clearly, Panini's EPS fluctuations were small and its profits were more stable. There are 5 reasons for choosing Panini. First, Panini has relatively stable profit fluctuations, which makes investments feel more secure. Second, Panini achieves sustainable growth through 153 stores and a mid-growth layout. Unlike Bonia, whose performance relies on one-time factors stored in scale mart, Panini covers the mass market and can perform shockers. Bonia is limited to a niche higher-end market. If its market suffers capacities, the risks are great. Fourth, in terms of cost resilience, even if import costs rise in 2024, Panini still maintains a new profit margin of 7.6%, which is very impressive. Fifth, the digital advantage is also very important. RFID, regional warehouses, and new urban applications will drive long-term revenue growth and enhance customer loyalty. Bonia does not have such advanced technological measure. In summary, from long-term investments, Panini is the best choice.
Here is a recommend and a conclusion. So, although Panini's leverage is slightly higher than Bonia's, its quick ratio has remained strong and interest cover is still stands at 8.7 times, similarly healthy cash flow. In financial year 2024, cost pressures cut profit, yet management responded quickly and keeping the net profit margin at 7.64% and also trimming safety stock to 60 days. Over the past 5 years, Panini has posted faster inventory turnover and steadier profitability, while its ESG agenda and the rapid deployment enhance traceability and reduce business risk. Rising costs in 2024 shaped gross profit margin by 3.16 percentage points and pushed the EPS down from 33.85 to 22.28 compared to Bonia. Inflation persists, EPS may struggle to rebound. In the highly competitive fast fashion market, products are very easily substituted. While balancing strengths and risk, Panini suits the long-term investors. We recommend building position gradually over the next 12 to 18 months and keep a close watch on net profit and other key indicators to adjust the strategy in real time.